Hello, and welcome to this episode of To The Point. I'm Neil Stanley, and today we're going to talk about something critical for all bank leaders today. How to make sure we don't lag unintentionally as interest rates rise as we price loans. Pricing loans profitably is going to take effort. There's going to be some grief as we leave overnight interest rates of zero. We need to know the score. We need to foster positive engagements, have a good strategy that we execute, and we need to measure and track results. And most importantly, we need to share those results with the right people on a timely basis. So denial is the first stage of grief. And as we leave overnight interest rates of zero, there are going to be some people who are feeling vulnerable in this. But there are also many opportunities because the expectations of rising rates can be a catalyst for new business development. So we must get past the denial. We must get past all of these other aspects of anger, bargaining, depression, and get to acceptance of the reality of the situation. That means knowing the score. We need to understand what the team is thinking and how they are approaching this interest rate environment. What do they know? How are they staying informed? What do they do to apply this knowledge? We understand that FHLB advance rates have changed from the last year where they have been rising in the short term and the longer term levels. We have now the 1 year is at 1.5%, the 3 year is at 2%, the 10 years at 2.5%. When we look at the FHLB advance rates as of February 18th, these are important metrics to be aware of because it matters in terms of the output of our loan production. When we look at what's happening across the industry, we can see the median loan tax equivalent yield is a 4.89, but the dispersion going down to the 20th percentile at 4.28, the 80th percentile at 5.63. We want to make sure that your pricing is deliberate and you're getting the results that you're looking for. That means positive conversations. How are you holding those? How are the conversations within the team occurring? What about conversations with borrowers and prospective borrowers? What expectations are in place today as we go through this evolving interest rate environment? Who sets the rate? How is that price set? What is it? When is it revealed? How do we share that with the buyer? All of these things are important in terms of understanding the process, and they don't happen accidentally. There is something that is driving your process. We want to make sure that you are looking at this very intentionally to get results that you're looking for in the marketplace. So some use loan pricing models, but you should all be using forward implied yields to assess the trade-offs, and understanding that preparing a number of price alternatives is always important to give your borrowers a choice. And that choice then is something that you want to be equally happy no matter what they take. But because rates are rising and they're not rising consistently across the yield curve, we need to understand the optionality in the options that we're granting. So be sure that you have a methodology for doing that. Ultimately, whether we're switching from variable to fixed, whether we are lengthening or shortening the term, all of these things, the amortization period, floors, ceilings, probability of default, adding collateral, adding borrowers, guarantors, all of these things, and of course the size of the loan impact our pricing decisions. So we know it's not a simple metric of here are how all 3-year loans should be priced. We want to make sure that you have been giving it due consideration in this evolving rate environment. Now, what does that look like? I think an empirical analysis of what we're actually booking is essential for doing a great job. Sort that loan data file by interest rates. Where are the highest rates? Where are the lowest rates? What did we do last month? Where are the outliers? What justifies the differentials? Who's accountable for these things? Senior management needs to have these conversations so that people know that leadership is watching. You may have heard of the Hawthorne Effect. The Hawthorne Effect tells us that people will respond to manage the things that they know leadership is observing. So how are you aligning your expectations with the results you're seeing and the aspirations you have? These are all critical things to influencing behavior. So the punchline of this message is make sure that you're opening eyes from within your team. Set the ability to get loan balances by interest rates. identify what was booked last month by relationship manager, by loan type. All of these things can be downloaded in a simple loan data file. Then use Excel pivot tables. If you need more information about how to use pivot tables, let me know and I'd be happy to help you. I have some to the point episodes on using pivot tables. Very critical to be able to slice and dice this data so that you can see where you're at. Make sure your team knows where the industry is. Make sure they know where you are as an organization. And then be sure to celebrate the positive results that you find. No matter how much activity is going on, there's always some good stuff and then some things that you want to maybe curtail. So this is the time where the market's in transition to be sure to be intentional about that. And most importantly, when somebody's doing a good job and they know you're watching, to give them that feedback of well done, good job. So I hope that you have gotten value out of this To The Point episode. Please contact me using the Calendly app to set up an appointment anytime you want to visit with me about this or other topics. It's been a pleasure to bring this to you. I look forward to the next episode of To The Point.